Okay, welcome to my YouTube channel. My name is Michael Dioba. Today we are going to look at consolidated of a financial statement, particularly the income statement. We are going to look at a worked example. That's what we're going to look at. And this has got a parent company, a subsidiary company, and an associate. So I want to see how we do the consolidation. Okay, I want to see how we're going to do a consolidation. So the accounting standard that is supposed to be applied in this particular case is the International Financial Reporting Standard 10, and also with the associate, we're going to look at International Accounting Standards 28 and International Financial Reporting Standard 10. Okay, International Financial Reporting Standards 10, IFRS 10, and the IAS 28. So let's look at the task before us in terms of question. We have Peace PLC that specializes in animal feed production and has a subsidiary in the name of Stable and an associate in the name of Amnesty. You are taken to be a financial accountant for this particular organization. Okay, you have a financial accountant of this particular organization, and you are asked to consolidate this income statement. Okay, so what do we have? We have these three statements, and it gives you revenue, cost of sales, through to determining what is your profit. Okay, what is your profit for the period? Okay, so let me just see if I can reduce this one so that it can be accommodating. Okay, that's a profit. That's what we have. Okay, so now to that we have additional information or notes. Okay, we have additional information or notes or relevant information. The relevant information is that on 1st of May 2021, actually Peace acquired 75% of equity shares in Stable. Okay, and the acquisition was through a share exchange of 2 shares in Peace for every 3 shares in Stable. Okay, and the market price of Peace at the date of acquisition is given as 5 kwacha 75 ingwe. That's Zambian kwacha 575 ingwe. Peace also agreed to pay a 2 kwacha for the 2 ngwe, the acquired share of Stable on 30th April 2023. So meaning that apparently is going to postpone payment for these shares until 2 years later. Okay, so we have this parent company that is producing or giving consideration in 2 forms, in form of shares, that is share exchange you are seeing here, also in form of cash, but cash is paid at a later date. Okay, also when we're saying that this will be paid on 30th April 2023, when stable achieves a market share price of 4 kwacha per share and the cost of capital is assumed to be or taken to be 10% per annum, and Peace has recorded the consideration. Second note, Peace acquired 6 million shares, equity shares in Amnesty on 1st January 2021. The acquisition was through immediate cash payment of 50 million. No fair value adjustment were required on the acquisition of Amnesty. We also have the third note, that is the fair value of property, plant and equipment of Stable at the date of acquisition was equal to the carrying amount with the exception of property and equipment. The property and equipment had a fair value fair values of 4 million and 2,400,000 kwacha respectively, in excess of carrying amounts. Then we are informed in this particular question the increase in fair value of property would create additional depreciation of 5% in the consolidated financial statements in the post-acquisition period to 31st December 2021, and the equipment had the remaining life of 4 years as a straight line depreciation is recommended here at the date of acquisition. Okay, we have the fair values have not been recorded in Stable's financial statement, and we are informed that all depreciation is treated as part of cost of sales, and we are advised to ignore deferred tax. We have note number 4, and we're going to look at note number 5, 6, and 7. What are we required to do? When you are faced with a question in an exam, in this case, this question is carrying 25 marks. Normally, we advise to first read the task or find out what is the task. In this case, go to what is required of you in the exam. So here we are required to prepare consolidated statement of profit or loss for Peace Group for the year ended 31st December 2021 in accordance with requirements of International Financial Reporting Standards and International Accounting Standards. Particularly here, as I've said, we are looking at International Financial Reporting Standard 10 and International Accounting Standards 28. So that will carry 22 marks. Then B, explain the meaning of the term control and significant influence in accordance with International Financial Reporting Standards 10 and the International Accounting Standards 28. Okay, so that's how we are going to look at this particular question in my presentation. So to start with, normally I advise students to actually look at the workings in a professional exam for chartered accountants. Okay, in a professional exam, you will find that the weighting of workings constitutes around 60% of what is required of you to answer a question. So you find that more than 60% will be workings, and then 40% is what is required to just do your final answer on that particular question. So in your looking at consolidated financial statements, I ask all my students to use this approach by first sorting out the workings, because you need the work figures to be included in the final solution. So it's a matter of looking at the workings, sort them out, then your task will be made easy. So that's what we do. Now, in workings for consolidated accounts, there is a structured approach to that, which I like students to follow. There is a structured approach to that. We normally, or I normally ask them to start by working number 1, where you show the group structure. Working number 1, you look at the group structure. In this particular case, the group structure is showing that Peace acquired 75% in stable, and you indicate the date, the 1st May 2021. That's when the acquisition took place. He also acquired 30% shareholding in Amnesty on 1st January 2021. So you indicate that one, so that you gives you a picture of what you are going to be dealing with in this particular consolidation. Okay. The next one we look at is net assets. Okay, net assets of a subsidiary. Net asset of subsidiary. So net asset of subsidiary, we look at 2 things. We look at the first column here is showing at acquisition. Then the next column is showing, the outer column is showing the figures at the reporting date. Okay, the reporting date. At acquisition of this subsidiary, that was on 1st May, according to this. Okay, that's 1st May, that's when it was acquired. Then reporting date, look at this, it is 31st December 2021. Okay, so you identify that. So how do you pick them? So the procedure is that the share capital for the subsidiary in this case, which is stable, is the 24 million kwacha. 24 million kwacha. So if you go to the it shows here equity shares of 1 kwacha each at 1st January was 24 million. Okay, the first one is for Peace, the second one is for stable, the last column relates to Amnesty. So we have Peace equity 35 million, stable 24 million. So Peace acquired at the 25% of stable, which at the time had the share capital of 24 million kwacha. So that's what we are looking at share capital of 24 million kwacha. So we pick that one, and that's what Peace found at the time of acquisition, 24 million. Okay, now this 24 million does not change. Okay, in terms of what we find at the reporting date, in this particular case, 31st December. So we are going to put again 24 million. Okay, now the next thing we do is we want to know what is it that we are buying. Okay, what is it that we are getting. So under acquisition accounting, okay, we emphasize control. So even if you didn't buy everything, but if you have 75% shareholding, it means that you have control over the net assets. So we are looking at what are the net assets we acquired at the time of acquisition. So we come to look at one of them is net asset can be looked at in this manner. So we look at what was used to finance the assets. We look at the accounting equation. The accounting equation is given as assets plus assets is equal to capital plus liabilities. Assets is equal to capital plus liabilities. So you can say net assets is equal to capital employed. Okay, so net assets is equal to capital employed. So we are going to use that particular analogy to determine what are the net assets. So we have capital here. Okay, what else? Retained earnings. Why do we add retained earnings here? It's because when a business makes profit, wealth of that particular entity grows. When the business makes profit, the company wealth grows. So that's what we have here. So we need to look at the retained earnings at acquisition. So how are we going to get the retained earnings at acquisition? So that's what I'm going to show you. Okay. Here we are given retained earnings on 1st January. For peace, there was 55 million. For amnesty, there was 10 million. For stable, the subsidiary, there was 69 million. Now this is on 1st January, but acquisition took place on 1st May. So meaning after 1st January, we ran with it for 4 months before stable was acquired. So now in the year ended 31st December 2021, stable made a profit of 13,500,000. 13,500,000. That's the profit stable made. 13,500,000. This for 13,500,000, since for the year ended 31st December 2021, it means that it covers 12 months. It covers 12 months, including the 4 months before it was acquired. So it has within this pre-acquisition profit. It was within this pre-acquisition profit. Now we are looking at the total pre-acquisition profit at the time of acquiring stable. So we have already got this profit, which is 69 million. At what date? On 1st January. So this 69 million under stable is the same as looking at profit or retained earning carried forward from 2020. Okay, so that on 1st January we have the opening balance. Then in 2021 we made a profit. Okay, stable made a profit. So now the acquisition is on 1st May. So meaning that this 13 million, we can claim a portion to be added to 69 million, and that total will be taken to be pre-acquisition profit. So that's what has happened in this particular case. That is what has happened in this particular case. So we have 69 million plus 13 million, 4 out of 12 months added to that 69 million, we are going to get 73 million. So that's what happened. So this 73,500,000 is the pre-acquisition profit under stable. Okay, at the time of acquisition, this is the profit. Okay, then the profit at the reporting date, which is the 1st December, you just add the two. So you know that there was 69 million and there's 13,500,000. You add the two, it will give you 82,500,000. That is the retained profit in stable that was there at the reporting date, which is the 1st December 2021. Okay, so now we go to the next one. We are given in this particular case in the note number 3 we have fair value of property, plant and equipment of stable at the date of acquisition, which was equal to the carrying amount. with the exception of property and equipment. The property and equipment had a fair value of 4,000,000 and 2,400,000 respectively in excess of carrying account amounts. So 4,000,000 in the excess of carrying amount on property, and then 2,400,000 in excess of carrying amount for equipment. So there was a valuation upwards. So the value shot up. So we are going to look at that and see how that affects the calculation of net assets. So what you need to do when there is a fair value adjustment, you add, okay, at the time of acquisition there was 4,000,000, meaning that even at the reporting date that particular adjustment stands. So you include 4,000,000 relating to property at the acquisition, then 4,000,000 relating to property at reporting date. Now, because the value of the property has increased, when it comes to calculating depreciation is depends on the value. You apply a percentage, for instance, on the value of the property of the asset to get your depreciation, a measure of usage of that asset. Because the base value has increased by 4,000,000, then it means that even depreciation has to be adjusted upward because there's an additional value of 4,000,000. So we have to calculate that depreciation adjustment. So in the note we are guided in the note relating to depreciation. Okay, we are guided in the note relating to depreciation. So we are told that the increase in fair value of property would create additional depreciation of 5% in the consolidated financial statements in the post-acquisition profit to 31st December 2021. Okay, so that's what it is. For us, the increase in fair value of property will create an additional depreciation of 5%. So that 4,000,000 will result in an additional 5% on the 4,000,000 valuation upwards. So that's what we are seeing there. So we go look at that, and how do we treat it? Is depreciation adjustment. So for property, 4,000,000 times 5%. Now we don't use we don't include it in the at the time of acquisition. We include that at the time of reporting, the reporting date. So that will give you a 200,000 kwacha. So mean that the retained earnings are being adjusted because that there is an additional adjustment here, and an additional deduction of 200,000. That's why it is deducted here, to have an effect on the retained earnings. Okay, an impact is felt on the retained earnings, 200,000 kwacha, and a subtraction because there is added value which led to increased depreciation. So that's why we put it here. Equally, in the same manner, we have fair value adjustment relating to equipment, as I've already seen. That is 2,400,000 kwacha. So at acquisition, we add 2,400,000 kwacha. At reporting date, we add 2,400,000 kwacha. Then with this, bring with it the depreciation adjustment. We are told that at the time of acquisition, in the note, at the time of acquisition, equipment had the remaining life of 4 years, straight line depreciation at the date of acquisition. Okay, so that's what we're told. So we are supposed to use straight line method, straight line depreciation. Okay, so it had a remaining life of 4 years. So how does that affect how we are determining the depreciation? Is this so meaning that this 2,400,000 has a remaining life of 4 years. So each year we are supposed to depreciate it by 2,400,000 divided by 4. So means that each year was supposed to be depreciating by 600,000. 600,000. Including 2021, the whole year is supposed to charge 600,000. Now, you should pause a moment and look at when did we acquire this particular, when did we make this acquisition? It was after 4 years after 4 months into 2021. 4 months into 2021. So meaning that Stable as a part of the group, Stable as a subsidiary in the year 2021, it was a subsidiary for 8 months only. For 8 months only. Because of that, we are going to look at the depreciation and claim the time, the proportion of depreciation when there was a Stable as a part of the group, so which is 8 over 12. So we get 2,400,000 divided by 4, so that we get the depreciation charge per annum. Then apportion it to just take the portion when there was a group, when Stable was part of the group. Hence we get 400,000. So as just like what I explained under depreciation for property, this has a knock-on effect on the retained earnings. It's an adjustment showing that there is an additional deduction from retained earnings. So we put it in the last column to have a deduction on retained earnings. So once we are done with that, then we just add what is the figures under the column of at acquisition, and what's the figure under the column of reporting date. So we end up having at acquisition, the net assets were 103,900,000 kwacha. At reporting date, we had net assets 112,300,000 kwacha. Now, when you look at these two figures, there is a time gap between acquisition date and the reporting date. Now, and with this time gap, we have seen that the net assets have increased from 103,900 to 112,300. What is the reason for that? It simply means that we made more profit to grow the net assets from 103,900,000, 103,900,000 to 112,300,000. The only reason we did that is because we made the profit. So there's a profit which was created after acquisition. We call it post-acquisition profit, and we get it by getting the difference between 112,300,000 and 103,900,000, which is going to be 8,400,000 kwacha as post-acquisition profit. Now we have interest groups here. Okay, there are two broad categories of interest groups: those who have a controlling interest and those who have a non-controlling interest. The one that has has controlling interest is Peace, because Peace acquires 75%, and the rest are banded into the non-controlling interest group with 25%. So this post-acquisition profit, since they are part of the group, they need to share it. So they will claim their proportion. So Peace will claim 75% of post-acquisition profit, hence getting 6,300,000. Whereas the non-controlling interest will claim their 25% out of the 8,400,000, hence getting 2,100,000. So that's how we do it. Okay, so we move on to look at the next one. After net assets, when we have get the group structure and we have the net assets, then the next is to get the goodwill. We run to determine the goodwill at acquisition and at the reporting date. So let's see how we do that. Goodwill of the subsidiary in the subsidiary. Okay. So what is goodwill? Okay, what is goodwill? Goodwill is an intangible asset. Goodwill is an intangible asset. Now, how does it come about? Okay. When you look at a company acquiring another, okay, getting control of another, okay, you acquire control by dictating terms, okay, and when you dictate terms, you are able to direct that particular entity in any way you deem fit. Means that you have control over that particular entity. Now, to obtain the control, you find that you look at trying to get the assets or control the assets of that particular entity. Now, when you look at those assets individually, they can be aggregated to a certain figure. Okay, they can be aggregated or summed up to a particular figure, a value. Okay, the actual value. Now, you find that despite you being given or knowledge about that value, when it comes to buying, you are even willing to pay more than what the aggregate actual values for that particular asset is. Okay, so that difference, the top up of what you cannot see in terms of assets, is what we call goodwill. So in this particular case, we are seeing this particular organization, which is Peace, tendering its consideration in terms of shares and cash, which is going to be paid later. So consideration is in form of shares and cash, which will be tendered later. Okay. Then also we take note of what is the fair value of non-controlling interest as well. So when we look at the fair value of Peace investment and fair value of NCI, compare it with the net asset at the time of acquisition, the difference, if it is more, okay, than the net asset, that is termed as goodwill at acquisition. If the difference is negative, then that will be termed as a capital recovery. Okay, so that's what it is. So that's what we have. So in this case, we start, look at the fair value of Peace investment. Okay, so we are told that you got 75% of 24 million shares in stable. So that's why we get here. But with that, she paid for those 24, 8 million shares, that is 75% to 24 million is 18 million. He paid for them by share exchange of 3 shares in stable for 2 shares in Peace. Okay, 3 shares in stable for 2 shares in Peace. And then the fair value of the shares at the time was given to be Zambian kwacha 5 kwacha 75 ingwe. So that's what given in this particular regard. So if you look at this under note 1, we are given this particular aspect. Okay, on 1st May 2021, acquired 5% equity shares through a share exchange of 2 shares in Peace for 3 shares in for 2 shares in Peace for 3 shares in stable. And at that time, the market price was 75 kwacha 75 ingwe, and also agreed to pay 2 kwacha for the 2 ngwe per share on 30th April 2023, meaning that this is 2021. We paid for them an additional one, cash in form of cash, on 30th April 2023. Okay, which means that will be 2 years later. Okay, when the share, when the stable shares market price will be 4 kwacha per share. Okay, so that's what we have in this particular regard. That's what we have in this particular regard. Okay, so that's what is put in here. So we consider that. So we consider that and come here and work it out. Okay. So we have, when you work out this one, 24 million times 5 times 2/3 times 5 quarters and 5, you're going to get 69,000. That is the fair value of the shares exchange. So the share exchange, the fair value of the share exchange comes to 69 million kwacha. Then we also have these 18,000 shares. There's another amount which is going to be paid per share, which is 2 kwacha for the tungwe per share. Not now, but after 2 years. Not now, but after 2 years. So you multiply 2 kwacha for the tungwe times 18 million shares. It's supposed to be 18 million shares. You get a figure. So let's look at this. Get a figure. Get a figure that is 18 million shares multiplied by 2 kwacha for the tungwe. You are going to get this 43,560,000 kwacha for the 3,560,000. That's what Peace will pay further to acquire these shares. Peace will pay further for the 3,560,000 kwacha in cash to acquire these shares. Not now, but after 2 years, on the 30th April 2023. Now, because this is a future cash flow, we are looking at this future cash flow. What is the value now? Now meaning that on 1st May 2021. What is the value now of 43 million which is going to be received in 2 years' time now? So we need to discount this. We need to have this for the 3,560,000 discounted. So how do we do that? Again, we are told that the cost of capital is 10%. The cost of capital is 10%. We are told the cost of capital is 10% per annum. Okay, so that's what we're going to use to calculate the discount factor. So the discount factor can be calculated. The discount factor can be calculated by looking at 10%, which is looking at 1 plus, okay, plus 10% is the same as 0.1. Okay, you get that one. Then since it's in year 2, you raise it to power 2. Raise it to power 2. Okay, so once you have that, that will be the numerator, that will be the denominator. The numerator is 1. The numerator is 1. So 1 over 1 plus 1, 1 divided by 1 plus r raised power n. That's how we get the discount factor. So it means that we have already got the denominator. We get 1 divided by 1.21. We're going to get 0.8264. 0.8264. That will be the discount factor at 10%. That will be a discount factor at 10%. So we come here and we look at that particular figure. So we're saying this 18 million shares times 2 kwacha for the tungwe, that will give us 43,560,000 discounted at with the discount factor 0.8264. We get the 6 million rounded up. Okay, that's how the 6 million. So meaning that the 43,560,000 which we are going to pay in 2 years' time is equivalent to 36 million now. So we are dealing with this transaction now, so the value will be 36 million as part of consideration. So that's how we determine the fair value of pieces investment, and then we look at also the fair value of NCI. So NCI. So meaning that out of the 24, 6 million shares belong to non-controlling interest, and we are guided that the fair value of non-controlling interest will be at 5 kwacha. So that's why we multiply by 5 kwacha. The fair value, we get back to that one. Okay. The fair value, Peace acquired 6 million equity shares in Amnesty on 1st January 2021. The action was through immediate cash payment of 50 million kwacha. No fair value adjustment was given. Okay. Then we are told that Peace policy is to value non-controlling interest at the date of which was 5 kwacha per share acquired. So if there is 5 kwacha per share acquired there, so that's what we have. Okay, that's what we have. Hence we end up having 6 million times 5 kwacha per share, giving us 30 million. So meaning these net assets at acquisition, okay, these net assets at acquisition are matched by these particular consideration, considering from the Peace investment and the fair value of NCI. So the difference giving us 31,100,000, which is goodwill at acquisition, whose date is 1st May 2021. Then we are told that this goodwill at the reporting date was impaired by 2 million kwacha. This goodwill at reporting date was impaired by 2 million kwacha. So that's what we are told. So saying an impairment test on goodwill of stable conducted on the 1st December 2023. So this is 2021. So 2021 rather, not 2021. Okay, 2021 was 2 million. At the same date, the value of investment in Amnesty was impaired by 500,000. So we are dealing with the stable. We take this 2 million. We take this 2 million. And the stable. We get this 2 million. And the stable. And we get this 2 million impairment. Means that at the reporting date, we have 29 million worth of goodwill. It has changed from 31,100,000 because it is impaired by 2 million. Now, at the reporting date, 29,100,000. So that's goodwill at the reporting date. Okay. So we move on to look at working number 4. In this space, we are looking at investment in associate. Investment in associate. Investment in associate. We are told that fair value of consideration of investment in associate was 50. Okay, 50 million. So maybe I move it a bit. Move it down a bit. Okay, there we are. Okay, so that's what we have. Okay, fine. Fair value of consideration for Peace investment, fair value consideration of Peace investment in the associate, which is Amnesty, is 50 million. That's what we are told. We paid 50 million. Peace paid 50 million. Peace paid 50 million. Peace paid 50 million. Okay, here it is. The acquisition was through immediate cash payment in Amnesty to the tune of 50 million. So that's the consideration. Okay, in the associate. In the associate. So we have 50 million. Now, this particular company, Amnesty, had made, let's look at that, had made a profit of 6 million. A profit of 6 million was made by Amnesty. Was made by Amnesty, 6 million. Was made by Amnesty at the tune of 6 million. Okay? So what do we do in this particular case? What do we do in this particular case? Yeah, Peace can lay a claim on his part of share. He had 30% interest in there. Okay, 30% interest in there. How do we know that is 30%? We come here. We look at this note number 2. Peace acquired 6 million equity shares in Amnesty. 6 million equity shares in Amnesty. So at the time of acquisition, equity shares in Amnesty were 20 million. Equity shares in Amnesty were 20 million. So out of the 20 million, 6 million were acquired by Peace. So what does it translate to? What does it translate to? So we can look at this one. 6 million divided by 20 million. We get that. Then times 100. We get 30%. So that is the 30%. That's how we determine the 30% in that particular regard. That's how we determine the 30% in this particular regard. Okay? So 30% post-acquisition profit of 6 million, we get 1,800,000. Okay? Then we are advised that there was also impairment in Amnesty of 500,000. There was also impairment in Amnesty of 500,000. We are told there was an impairment in Amnesty of 500,000. Okay, so let's look at that particular part. Where I got this impairment. Okay, this part, you see that at the same date, the value of investment in Amnesty was impaired. Which date? 31st December 2021, the reporting date. There was an impairment in Amnesty of 500,000. So that's what we pick. Yeah, pick that one. Okay, so it was impaired by 500. So that's how we deduct this one. So meaning that investment in the associate Amnesty will reduce from 51,800,000 by 500 to 51,300,000. So that's investment on the associate. Okay, so that's what we have there. So now after looking at that, we look at the next, which is non-controlling interest. Okay, non-controlling interest. We want to know what is the value of non-controlling interest. Okay, so fair value of NCI, we are advised to get that one from the calculation of goodwill. And the working number 3, we have goodwill, fair value of NCI, which is 6 million shares times 5 kwacha per share, giving us 30 million. That's the fair value. Okay, so that's what we pick from there. That's what we pick from there. Okay, and we bring it here. That is the 30 million you are seeing. Then these non-controlling interests are a post-acquisition profit shared, which we calculated as 2,100,000. 2,100,000. Post-acquisition share, which was calculated as 2,100,000. So we did calculate that figure, 2,100,000. This is the figure here. Stable's share of post-acquisition profit. Okay, we calculated at 2,100,000. So that's what we bring in here. Okay, we bring in here 2,100,000. That's what you see. Then again, there was impairment of goodwill of 2 million. So the non-controlling interest should also take a share of that. So since non-controlling interest has 25% stake in stable, 25% of impairment, which is going to come up with 500,000. So 25% applied on 2 million impairment, that gives you 500,000. So they need to shoulder that as well. So you have 30 million plus 2,100,000 minus 500, you get 31,600,000. That is NCI at the reporting date. NCI at the reporting date. Okay, NCI at the reporting date. I went also further to look at group reserves. Now, this is not necessary for preparation of income statement consolidation. It is the most appropriate when you are doing the consolidation of statement of financial position. But in any case, I did come up with this just to show you how you deal with this particular case. Okay, how to deal with this particular case in this particular regard. Okay, so you need to create two columns. A column for retained earnings and also other reserves. Okay, other reserves. So in this particular case, we pick the parent company's reserves. The parent company reserve, it comes to 78,700. So how do we get that one? Okay, you come here. Okay, parent company retained earnings, these are reserves. The parent company on 1st January had 55 million. Then this 55 million was brought forward from 2020. So now in the current year, the parent company made reserves of profit of 23,700,000. 23,700,000. That's what the parent company piece made. So in total, it means that the retained earnings has accumulated to 23,700,000 plus 55. 23,700,000 plus 55. So that is the 78 million I'm talking about here. 78 million I'm talking about here. 78,700,000 I'm talking about here. Then there are also, that is from the parent company alone, but he's also acquired some share from the stable company, okay, the tune of 75% of the post-acquisition profit, which is we calculated as 21. Okay, then these earnings or reserves were reduced by an impairment. To the tune of 2 million. Therefore, this reduces to 78,800,000 as group reserve. Okay, group reserve. So that's what happened. So the group reserve, you don't consider the reserve for the subsidiary. You only look at the parent company. And then you add to it the post-acquisition profit, in this case 2,100,000. And then you look at the impairment loss. This is 2 million to arrive at 78,800,000. So that's what you do. Okay, that's what you do. Then we move on to the next workings. In this particular case, I looked at the unrealized profit. The unrealized profit. That's what we have. What is the unrealized profit? How does it come about in this particular case? In the context of the group, you find that companies in the group can be trading or can be transacting. Okay, so can be selling and buying from each other. Now, when the company sells goods to another company in the group, the logic is, the analogy is that it's just relocating the asset from one point to another point in the same company, because the group account is prepared on the principle that we are preparing accounts as if it's a single entity, so the same entity. So when you move assets from one company to another in the group, you are just like moving money from one pocket to another pocket. You are the same person, so that is not, doesn't count as a sale. Doesn't count as a sale. In a similar manner, the profit you have made, it cannot be realized. Okay, it has not been realized. It is only realized when you sell to an entity outside the group. When you sell to an entity outside the group. In this particular regard, we are advised that there was sales going on. Sales were going on. Let's look at that. Sales were going on. It says on note number 6, from 1st January 2021, Peace, which is the parent company, sold goods at a selling price of 1,250,000 kwacha per month to Stable, okay, which is a subsidiary, both before and after its acquisition. Peace was adding 20% markup, and at the 1st December 2021, the Stable still held 3 million kwacha at cost to Stable of goods bought in the post-acquisition period. So what implications do we have here? So Peace and Stable are members of this group. So Peace sold to Stable, which is an entity within the group. So the profit which Peace was adding here did not get realized, because these goods, 3 million worth of them, did not get sold to somebody or some entity outside the group. So the Peace, which is the Peace profit, is unrealized. So Peace profit is unrealized. We have to take it out from the figure of profit, because it's not realized. So the question is, how do we get this unrealized profit? Here is the trick. When you look at this percentage, I thought Peace was adding 20% markup. Okay, so in this type of questions, you have to be particular with the percentage to determine the profit. If the percentage given is to be applied on the cost, then that percentage is known as markup. If the percentage given is to be applied on the sales or revenue value, then that percentage is known as margin. So you cannot apply markup on revenue. Okay, you have to apply markup on cost. Similarly, you cannot apply margin on cost. You can only apply margin on sales. Now look at it. Here, Peace was adding 20% markup. Peace is the one who sold goods to Stable. Okay, and these goods worth 3 million are being kept by Stable at the time of reporting date. There was still 3 million worth of goods with Stable, because they had collected them from Peace. Okay, now this is the sales value. This is the sales value, because this is what Stable bought them from Peace at. So for Peace to sell Stable 3 million, it means that he had already added the profit markup on the cost to arrive at the selling value of 3 million. So we cannot use this 20% because the markup on the sales. We have to find what is the equivalent of margin to this 20% markup, so that we can apply that margin on the sales. Okay. So now what we do is this. Okay, so we look at cost plus profit, which is equal to to sales, selling price or selling value, sales. Okay, so in this case, what do we have? Cost is taken to be always 100%. Okay, profit is what told is 20% on cost. So 20% on cost to arrive at the sales value, which is going to be 120% in this particular case. So that's what happens. So now we want to know what is the proportion of profit in the 3 million. So using this type of analogy, we are going to say the proportion of profit in 120 would be 20 divided by 120. Okay? 20 divided by 120. So this is the margin. So if you want, you can have this multiplied by 100 to express it as a percentage, so that you get a percentage margin. Okay, get the percentage margin. Or you can look at this profit 20 divided by 100. Okay, again you can multiply this one by 100 again. So meaning that you have this. You're going to get okay, multiply this one by that. You're going to get just like here, a percentage. Markup. So as I've said, a markup is on the cost. A markup is on the cost, while a margin is on the sales. Margin is on the sales. So that's the idea. Okay. So we pick this one, which is a percentage on the sales, 20 over 120 in this case. So when you look at 20 over 120 in this case, we're looking at margin So we have 3 million. We have 3 million multiplied by 20 divided by 120. So if you work out that one, it will give you 500,000. Okay? So meaning that within 3 million, there is a profit which piece added on the cost of 500,000 to arrive at 3 million. Means the cost of this goods sold for 3 million was 2,500,000, because 500,000 was a profit added on it to get 3 million. Okay, so that profit of 500, because the goods are still within the group, this 500,000 is unrealized profit. This 500,000 is unrealized profit. Unrealized profit. That's what we call unrealized profit. So that's how it is done. So here I've done some calculations for you. I've done some calculations for you and worked out this one. So you see this, the 3 million unrealized profit is the 500,000 you are seeing there. And the sales for the 8 months when there was the stable company as part of the group for 8 months in 2021, the total sales made were 10 million kwacha. Okay, so that's how it is. So that's what we have. And we also do another calculation for deferred finance costs. Okay, there's a note to that effect when you need the deferred finance costs. Okay, so it tells you the finance costs are note number 7. The finance costs of peace do not include peace costs, finance costs on the deferred consideration. All items in the above statement of profit or loss are deemed to accrue even over the year. So this statement, what is the deferred cost? Okay, what is the finance cost? Okay, the interest. Okay, it's the interest. So we are told that finance costs of peace do not include finance costs on the deferred consideration. What is the deferred consideration? We worked it out as 36 million. The deferred consideration was worked out as 36 million. It was worked out as 36 million. Deferred consideration was worked out 36 million. Okay, which is here. 18 million shares times 2 kwacha for the tungwe, discounted at the discount factor of 0.8264, we got 36 million. So this is more like being lent money, and when you borrow money you pay interest. Okay, you pay interest because this particular piece entity is going to pay 36 million in 2 years time. Meanwhile, it has used this type of financing to acquire control, as part of the consideration to acquire control. So the interest for the year accruing is 10%. We are told that the cost of capital is 10%. Okay, so we have this particular calculation. So 10% of the 6 million. Now 10% is for the annual. So we have only 8 out of 12 months when this stable was part of the group. So we apportion that one to get the 2,400,000. That's the deferred cost, finance cost. So I've done the workings which need maybe separate presentation. So we now look at the solution itself. We slanting the figures, slotting the figures for the solution. Okay, so that's what I have here. Let's put it down there. Okay, fine. When you have control, parent and subsidiary, the idea is to go line by line and add everything between the subsidiary and the parent company, with the exception of certain adjustments which need to be made. So in this case, we start now going the easy task. The hard task is done. We just look at the statement, financial statement, the income statement rather, and start adding item by item, line by line. Okay, we have piece and this subsidiary stable. So we add the 150,000, 150 million sales revenue under piece. But remember that this 78,000 under stable, this 78,000 under stable was earned over 12 months. But stable became part of the group only for 8 months. Then it means that we have to get just the proportion of the time on the time basis when stable was part of this group, so which is 8 months. So we're going to get 78,000 times 8 over 12 to get what is supposed to be added to the parent company, 150 million. So that's what we do in this particular case. So when you come here, actually notice that is what is done. So we have 150 million plus 78 million apportion 8/12. Now, when you are dealing with the intercompany transaction, as I've already mentioned, a sale between entities in the group is not counted as a sale. It was just a relocation of items from one position to another within the same entity, with a single entity group. Okay, so in this case, we calculated the intercompany sales, which came to 10,000, 1,250,000 times 8 months. That gave us 10 million under working number 7. So that is intercompany sales. So we remove it from the sales. So meaning that the piece did not, in terms of a group, sell goods worth 10 million to stable. Okay, so you cross it out from sales revenue of piece. That's why we are subtracting 10 million here. Okay, so we end up having 192 million kwacha as sales, group sales. Then we go to the cost of sales. Cost of sales, you get the cost of sales and the parent. Cost of sales under the parent, which is 94. And we get cost of sales under stable, which is 51 million. Then we apportion it to get 8/12 of that, add it to 94 million. And a few adjustments I want to explain, which you need to be familiar with in this particular case. So the first part is what I was saying, you get 94 million, add 8/12 of 51 million from stable. Then again, stable bought goods from piece. So in the cost of sales, he has purchases, which is sitting at 10 million. Since it's the same group, that was not a purchase. It was just a relocation of stock items from point in the same group from piece to the point in the same group of stable. So we cancel that one from the cost of sales, because in terms of a group, it was not a purchase. So we remove 10 million from cost of sales of stable. So 10 million is coming out from the cost of sales of stable. That's why you have 10 million here being subtracted. Then we are told that there is a note here. There's a note here to say under note number 3. The fair values have not been recorded in stable financial statement. All depreciation are treated as part of cost of sales. So depreciation are treated as part of cost of sales. So in the cost of sales, remember we did work out under working number 2 the depreciation adjustment relating to property of 200 and also depreciation adjustment relating to equipment 400. So these are part of cost of sales. So instead of having cost of sales coming under let's say expenses, the distribution or whatever, so according to this policy of this particular group, the depreciation are taken as part of cost of sales. So meaning that they are going to be lumped to the cost of sales so that they are deducted from revenue, then it will have the same effect. So that's why we bring 200 here and 400 here being added to the cost of sales. Okay? Then the other thing is the 500, the unrealized profit. The 500 unrealized profit. Because piece which sold had included 500 in the profit, because it's included in the sales value under piece. So we are saying you shouldn't do that in terms of a group, because these items were not sold to an entity outside the group. So the profit is unrealized. So how do we do that? We have to reverse that. We subtract it from what included in the sales. the 500. So how can we do that? Because cost of sales is subtracted from the total revenue, we can add 500. So if the total 500 is part of the total 119, 100, so when you subtract it from there, we are actually deducting the unrealized profit. We are actually deducting the unrealized profit. So that's what we're doing. So that's why the unrealized profit is added cost of sales here. So we are going to get the gross profit. After subtracting that, we get 72,900,000. Then distribution cost, we just add the portion of the parent, which is 7 million, plus 8 out of 12, the subsidiary, which is 3 million, to get 9,140,000. Okay, we go to the administrative expenses, the same. The cost of everything up in the for the parent, and the 8 out of 12 or the subsidiary. Okay. If the whole year had been the period of account, then we would have not been using the 8 out of 12. We would have just been adding 7,400,000 plus 3 million to get the total year. Now we are apportioning because the group ran from 1st May to 31st June, only 8 months. So we only claim that for the group at 8 over 12 for the cost from the from the subsidiary stable. So here we have 12,500,000 plus 8 out of 12 or 6 million from stable. We get 6,500,000. This finance cost, we have 2 million from the parent, 2 million from the parent, 2 million from the parent, 2 million from the parent. We get 8 out of 12 the subsidiary. Okay, and also remember there was deferred cost. Okay, finance cost which was not added, so we bring it in this time. Okay, so we have 2 million from the parent, 900,000, get 8 out of 12, then plus the deferred finance cost, which is 2,400,000, which we calculate under working for, we get 5 million. The other expenses, talk about goodwill impairment, the loss, so we bring it here, the 2 million, which were given in the note. Once we have done that, we look at the associate profit. We get the associate profit. We just get the associate profit. So what is the associate profit? We worked out this one under working for. Okay. The investment in associate, we had post acquisition 1,800,000. Then it was impaired by 500. So 1,800,000 minus 500 give you 1,300,000. That's the profit. That's the profit. So which is 1,300,000. So once we have done that, we add them up, we get profit before tax of 41,300,000. 41,300,000. Then the tax expense, again, we look at that for the group, which is going to take all of the parent, which is 10,400,000 as the tax expense, all of the parent, which is 10,400,000, 10,400,000, and then a proportion according to the time basis, which is 8 out of 12 of the subsidiary, 3,600,000. So that's what we have here. So 10,400,000 and 3,600,000, 8 out of 12, we get 12,800,000. Then we end up having profit for the year, which is 28,500,000. 28,500,000. That's what we have. Okay. Now we also look at an analysis where we look at what is attributable to the parent of this profit and what is attributable to the non-controlling interest. What is attributable to the parent and what is attributable to the non-controlling interest. So we have this particular arrangement. Profit attributable to parent and NCI. So we look at what we readily have. We have NCI, which is the profit made under working 5. We came up with under non-controlling interest. We know that there was the post-acquisition profit of 2,100,000, which was impaired by 500. So if you subtract 2,100,000 from 500 from 2,100,000, you are going to get 1,600,000. That is a profit attributable to non-controlling interest. Profit attributable to non-controlling interest, 1,600,000. So the total is supposed to be 28,500,000. So if we know that out of this 28,500,000, 1,000,000 is relating to non-controlling, then the balancing figure, which is 26,900,000, is attributable to the parent company, which is Peace. So that's how we get the total 28,500,000 again. So that's how we prepare this particular consolidated income statement. Then we look at part B. It's a simple one where we are asked to explain what we mean by control in accordance with International Financial Reporting Standards 10, where I've just said that this is the exposure or right to variable returns, to different returns of investee. So which is the investee? The subsidiary, and the power to affect the returns from the investee. So you can actually dictate terms of how these returns are going to be to you. Okay? So you're going to affect them in this particular case. So that investee, where Peace invested money, it's stable in this case, which is the subsidiary. So stable was acquired by Peace. Peace obtained control at the time of acquisition because Peace got 75% shareholding in Stable. So Stable became a subsidiary. Then we also have the other term, which is significant influence. According to the definition by International Accounting Standards 28, this is the power to participate in the financial and the operating policy decisions of the investee company. So you have significant influence if the ownership is ranging between below 50% and down to above 20%, and below 50%. Then you have significant influence. So what does this mean? This is the power to participate in the financial and operating policy decision of the investee company. In this case, the associate, which is Amnesty. Okay. So that's what this question is supposed. That's how this question is supposed to be handled. The exam type of question in financial reporting. So thank you for listening. If you have any questions, you can drop me a line, and please don't forget to subscribe to my YouTube channel and also like my video.